Welcome back. Part two. Alright, so I'm gonna break down the coverages, okay? On this when your insurance agent give you your policy, this is gonna be page two. So it's basically gonna be your table of contents, right? So you always want to pay attention to coverage A, which is your dwelling. So your dwelling mostly is basically your house, right? It's the wall, roof, and if you have a attached garage, right? Attached garage, not detached, okay? So that's the structure. So in the policy or in the declaration page, it gives you the percentages or how much each coverage is owed to pay out, the limit, right? So your coverage A is going to be 100% of replacement cost, right? That means it's not the actual market value. This means replacement value is what it actually costs to rebuild your home. So if you, let's just say hypothetically, like, I think that was 2 years ago or last year, when California had all those fires. Well, you were paying people out what it costs to rebuild their home, not what the market value of the house is. Okay. So, for example, if rebuilding your home costs $200,000, then coverage A, that's what we're gonna pay you out if your house was burnt, right? If your pipe was burst, then and it flooded your basement, and we have to reconstruct that entire basement, or your claims adjuster says that, hey, it looks like that's what we're gonna have to do, then they would pay up to $200,000, right? That's gonna be your limit. Now, when you're moving on to coverage B is your other structure. So those are things like detached garages. A lot of people have those. If you have a shed, if you have a fence, then that is what coverage B would be for, is other structures. Now, typically, it's 10% of coverage A. The limit would be somewhere around 10%, right? So let's say, for example, in your coverage A again is 200,000, then coverage B would be 20,000, right? That would be the limit. That's what you pay out. So if your fence costs 30,000, meaning that it's to a loss leader, the entire fence costs £1,000,000, which typically that would be, let's just say that, then you're gonna pay 20,000, and you're gonna calculate that 10,000 plus whatever. Always remember you have to pay a deductible, right? Okay. So moving on to coverage C. Coverage C is your personal property. Very, very important about your personal property. Usually that's about 50 to 70% from your coverage A, right? So if your coverage A again is 200,000, then that would be coverage C would be limited to somewhere around 100,000 to 140,000, okay, for the limit. Now, coverage C is personal belongings. So that means any of your furniture, your electronics, your clothing. So what you always suggest with people with coverage C, that you want to go around your house and price how much your furniture is, your TVs, your computers, things like that. Just so you'll know, when they ask you, when your agent asks you, how much do you estimate the value of your personal property, you'll know somewhere around that, right? Because if you have a fire and you lose everything in the house, you want to make sure that you're able to replace most of those items, right? You don't want to undervalue what you have. So I always suggest that just go around your house and just kind of do a rough estimate. I mean, don't go crazy on it or whatnot. Now, what you can do as well with personal property, if you married and you have a ring, a wedding ring, You want to make sure you get a endorsement for that one, or what we call a rider. So that's extra coverage for that wedding ring. I have a lot of claims where, as a matter of fact, I had one not too long ago where a wife got on one of those rides at Universal Studios and her ring fell, and she just called in. She had the endorsement, and we was able to pay her exactly what the ring was worth. Now, when you get those endorsements, they're going to ask for an appraisal, so you're going to have to get the ring appraised so that way we can pay you properly. Okay. So that's it for part 2. So we're going to go into part 3. Like, share, and comment.